The next two sections of the neophyte level are very important. Why is that? Because many of us get excited about discussing trade setups, but when we start to talk about exit strategies, we get bored and zone out. Why do we like talking about entries so much and not so much about the exits? Well, think of it this way. When we put a trade on, it's always a positive experience, isn't it? We're incredibly optimistic. We're thinking maybe this is the big one that we've been waiting for. We're going to make so much money on this trade. However, when it comes to liquidating a trade, half the time we lose money, and who likes that? And the other half of the times when we do win, we usually beat ourselves up after the fact, because as the days go by, we look back at that trade and we think, man, I wish we could have sold it the exact high or low of that day or that week or that month or that year. We have a tendency to beat ourselves up after the fact. However, we have to remember this. When we do make money, when do we make the money? On the entry or the exit? We know it's the exit, so let's learn to overcome our fears and look those trading losses in the face. The key here is to learn from your losses. That's what professionals do, and rookies don't. This is one of the hardest aspects of trading. Humans instinctively want to move away from pain, and admitting you're wrong is hard, especially if you think you're perfect. Don't take it personally. If you take losses personally, you will never achieve success at trading. Remember, according to Sir James Matthew Barrie, he said, failure is the path of least resistance. Don't give in to the tendency to quit. If you're passionate about this, keep going. Don't give up. In this section, we're going to discuss how to use trailing stops to stop getting stopped out. We've discussed the best way to enter the market. We looked at the Gartley pattern, the ultimate trading pattern, but now we need to marry a great trade setup with a great exit strategy. Let's now discuss what type of stops work the best and where to put them. Now, has this ever happened to you? Let's imagine that you are a buyer right here on a breakout above the high of this bar, and you initially put your protective sell stop order down here to protect yourself in case you're wrong. Now, let's see how our trade works out. The next day, this happens. Boom. You get stopped out right there. And so you might think, that's okay, that's part of trading. You can't win them all. However, unfortunately, what often happens is this. Has this happened to you? If it hasn't happened already, it's going to. You know what I call this? I call this ED, or entry dysfunction. And this is an ailment that affects both men and women. However, there is a cure, and it's not a blue pill. The cure is to use volatility-based trailing stops. Volatility-based trailing stops look at recent market volatility. They're dynamic, they change, unlike other strategies that are static or remain the same distance from the market throughout the trade. Just as there are cycles of trend and counter trend, there are cycles of high volatility and low volatility. Typically, there is lower volatility during a trend and higher volatility during a trend reversal. A lot of traders are trying to find the beginning of a new trend, so they put trades on at zones where the trend is expected to reverse. And it's in these zones where there is usually higher volatility. So doesn't it make sense that our stops should be farther away in these areas? And that the stop might trail closer during the trend move? Let's have a look and examine this idea a little closer. Cycles of volatility exist in all liquid financial markets. Typically, volatility will increase when the market has a significant reversal. This volatility will decrease once the reversal is finished and the market begins to trend. Then it will increase again when we go into a reversal. Now look at this daily chart of 3M, and it shows you how volatility expands at significant reversal points. Now down on the bottom of the screen here, I've plotted a historical volatility indicator, and this indicator shows us where there's an increase in volatility compared to the previous 10 days. Notice that the volatility is higher right here above this line, and it's at this reversal point right here that we have high volatility. After the reversal point, the volatility starts to be reduced as the trend asserts itself. So it starts to move higher here, and we can see that the volatility has gone down. Then we go into another reversal up here, and volatility goes higher. We go into a trend, volatility goes down. We hit another reversal area, and volatility spikes. We have a reversal here, and so the trend starts to go up again and volatility shrinks. So can you see the cycles? How do these cycles relate to our trailing stops? The strategies that we use in the geometric trading course involve specific buy and sell signals at these significant reversal points, like here, here, here. It's important to note that if volatility is high in these areas, then our stop should be farther away. Then as the markets begin to trend and volatility decreases, we can ratchet up our stops and bring them closer to the current price. Then with our stops a little bit closer, if volatility increases again at the next reversal point, we will be stopped out. And in that case, getting stopped out is a good thing. One of my favorite volatility-based trailing stops is what I call the 3-bar trailing stop. And here's an example of what it looks like on a chart. Once again, I have the historical volatility indicator displayed at the bottom. Notice how the volatility is higher here at the reversal point. And then from there, it starts to decline as the market starts to trend. Then as the volatility starts to increase, it's only at this point we start going into a reversal zone, and the 3-bar trailing stop would have kicked us out here at 88.42. This is a chart of 3M. Now let's go through the rules for the 3-bar trailing stop so that you can start using this stop immediately. So the rules for the 3-bar trailing stop are very simple. To make it easy, I'm going to teach you with just a simple long position. If you want to apply these rules to the short side, just reverse the rules for shorts. Now let's imagine that you're a buyer right over here, that your buy signal was generated from a breakout above the high of this bar here, and that now I'm long. Now what you need to do is to count back 3 bars and use the lowest low of the last 3 bars. And that would look like this. 1, 2, 3. And so there's the lowest low of the 3 bars. You put the stop right below the low of the 3rd bar. The lowest low is on bar number 3. And you don't have to put your stop on the exact low of the bar. In this situation, you should be a little penny foolish and put it at least 1 point past the low. If you're wondering what the red arrows are for, over here, these red arrows are pointing to inside bars. Now, inside bars are not drinking establishments. Inside bars are price bars where the range is inside of the bar immediately to the left of it. So notice the range of this bar from the high to the low is inside of the range of this bar right here. So this is an inside bar. We go over here, we notice that the range from the high to the low of this bar is inside of the range of the bar immediately to the left. And likewise with this one here, just a little bit of a narrow range here is inside of the range of the bar immediately to the left. We're not talking 2 bars ago, 3 bars ago. It has to be in relation to the bar immediately to the left. So those are inside bars. The reason I mention the inside bars is that when we count our 3-bar count, we need to skip inside bars. So now let's add some bars and see how our 3-bar trailing stop works out. So we've added a bar here and we count back 3 bars. We don't see any inside bars, so we count 1, 2, 3. The lowest low is on bar number 3, so we'd put our stop right there. All right, let's add another bar. Okay, so this is an inside bar. We're not going to count that one because the range of this bar is inside the range of this one, so we don't count this one. And basically our trailing stop is going to remain exactly where it was the last time on the low of bar number 3. Now let's add another bar. Okay, so this is not an inside bar. We're going to count that one. So there's bar number 1. We skip the inside bar. We count bar number 2, bar number 3, and the lowest low here is on bar number 3, so we put our stop there. Let's add another bar. Okay, we didn't get stopped out. This is not an inside bar, so we count it. We count 1, 2, skip the inside bar, count 3. The lowest low is where? On bar number 2 now. So don't forget, it's not always on bar number 3. Sometimes it can be bar 1 or 2 or 3. Let's press on. Let's add another bar. Okay, big range bar here. We count that one. That's bar number 1, bar number 2, bar number 3. There's no inside days here, so the lowest low is bar number 3. That's where our stop is. Let's add another bar. There's 1, 2, 3. Stops on bar number 3. Add another one. 1, 2, 3. No inside bars. Bar number 3 is where our stop is. That's an inside bar, so we don't count that one. So 1, 2, 3. The stop stays where it was last time. Okay, here's another bar. 1, skip, 2, 3. Lowest low is now on bar number 1. You can see how it's ratcheting the stop higher and closer to the market as it goes sideways. Let's add another bar. 1, 2, 3. Remember, skip the inside day, and the stop is on bar number 2. There's another bar. We count that one. 1, 2, 3. Lowest low, bar number 3. Add another one. Getting very close here. 1, 2, 3. Lowest low, bar number 1. Bit of a reprieve here. Goes a little bit higher. We count that one. 1, 2, 3. Lowest low is bar number 2. This is an inside bar, so we're not going to count it. So the stop stays where it was last time. Add another one here. We count that one. 1, skip, 2, 3. Lowest low is bar number 3. Count that one. 1, 2, skip, 3. Bar number 3 has the stop. Here's an inside bar. We don't count that one. Stop stays where it is last time. Add another bar. We have a bigger 5-minute bar now, so we count that one. 1, 2, 3. Skip the second bar. It's an inside bar. There's your stop on bar number 3. We count this one. 1, 2, 3. Lowest low is bar number 3. Bar number 3. Bar number 2. Bar number 2 again because we have an inside bar. 1, skip, 2, 3. There's our stop. Okay, now our stop's on bar number 1, and boom, we got stopped out. So our 3-bar trailing stop worked out okay. Notice how it kept us in even during this long sideways movement here. Remember, as it trends, the market trends, the volatility decreases, our stop gets closer. However, it still kept us in for all that time. So now that you know how to use the 3-bar trailing stop, you can use this on any product on any time frame. You can start using this right away. In the initiate level of the geometric trading course, we look at using the 3-bar trailing stop on multiple time frames. Now, if this seemed a little complicated or you want something a bit more automated, there are 3-bar trailing stop tools built into some trading platforms. Let's now look at an example of an automated 3-bar trailing stop in Market Analyst. In this example, we're going to look at applying a 3-bar trailing stop to the mini Dow futures on a 5-minute bar chart. Here's going to be our theoretical entry point. What we want to do is be a buyer of one Dow futures contract 1 point above this high here on this bar. Okay, so there we go. We got filled at 60. Now what we're going to do is apply the 3-bar trailing stop. To do that, go to Tools, go to Beck. At the bottom of the list here of the Beck's toolkit, we have X bar trailing stop. The reason I called it that is because it can be any bar trailing stop. The 3-bar trailing stop is a good all-purpose number that we like to use. So let's apply the 3-bar trailing stop to our chart here. To do that, we click just under our entry bar here. Click, and now you can see that the line is starting to display the 3-bar trailing stop. So it's telling us that our stop is at 12,042. That would be the lowest low of the past 3 bars. So we count back 1, 2, 3. So there's our lowest low. Okay, so let's add some more bars and see how the trailing stop moves higher. And that's what a trailing stop really does. It moves in one direction here. It doesn't go backwards. So as you notice, the blue line, as we add bars, it will only move up. So let's add some bars here. We're up to 46. There's an inside bar. It ignores that. Comes down. Our stop is at 51. Nice reversal there. Stops at 52. Stays at 52. We got some big range bars. Stays at 52. Jumps up to 73. See the 3rd bar right there, just 1 point below that. Inside bar, we don't count that. Okay, so the lowest low is the most recent bar. We're 1 point below that. That's where our stop is. Stays at 84. Stays at 84. Stays at 84. 84. 84, there's another inside bar. Don't count it. So despite this range of sideways price action, we are still in this trade, which is nice about this trailing stop. It's based on volatility. Okay, so now it's finally moved up to 87. Ignore the inside bar, moves up to 89. 90. 92. 02. Inside bar, stays flat. Still at 02. 05. Boom. Big gap there. It's not perfect, however, it's a great mechanical way to keep you in a trade based on recent market volatility. So that's a good example of the 3-bar trailing stop applied to a 5-minute bar chart of the mini Dow futures. Now that you know about the benefits of using volatility-based stops, let's now consider another really important aspect of trading, risk management. Risk management is a complicated subject. However, I would like to share with you one simple tool that's really easy to use and will change your trading approach forever. Let's learn how to use this tool because it's an easy way to reduce risk.